So you want to own an offshore oil rig? Here's the sales pitch. Buy one enormous machine, rent it to an energy company, collect almost $500,000 every day. In the second quarter of 2026, Transocean's ultra-deepwater floaters generated average daily revenue of roughly $455,500 per operating day. Run that number across an entire year and you get more than $166 million from one machine. Sounds almost unfair. Except in that same quarter, Transocean's ultra-deepwater fleet utilization was only 72.6%. That is the part the headline day rate hides. The rig earns extraordinary money when it is working. The calendar decides how often that happens, because an offshore rig does not make money simply because it exists. It makes money when a small group of customers needs exactly that class of rig, in the right region, under the right contract. And when the customer disappears, the rig remains yours. So do its maintenance requirements. So do its financing obligations. So today, we are going to buy one. We will choose the rig, find the customer, sign the contract, collect the day rate and see what is left. And by the end, you will understand why the most valuable part of an offshore drilling business is not simply the machine. It is the future calendar attached to it. There are several kinds of offshore drilling rigs, but we do not need a catalog. The decision is much simpler. Do you want to operate in relatively shallow water, or do you want access to the most technically demanding deep water projects? For our business, let us go big. We want an ultra-deepwater drill ship. And now the numbers become uncomfortable very quickly. Transocean has reported total costs of roughly $1 billion for the Deepwater Atlas and approximately $1.165 billion for the Deepwater Titan. That does not mean every modern drill ship costs exactly $1 billion. It does show the scale of the asset. So perhaps you decide not to buy new. You look for a deal. And this is where offshore drilling starts behaving like an extraordinarily expensive used equipment market. In 2022, a joint venture involving Transocean agreed to buy the unfinished drill ship then known as West Aquila for approximately $200 million. $200 million sounds much better than $1 billion, except buying the hull was not the same thing as owning a ready-to-work rig. Transocean later reported that the full Deepwater Aquila construction project was completed for a total cost of roughly $440 million. The bargain has already become a very different investment, and we have not earned $1 yet. So the useful question is not, how cheaply can I buy the rig? It is, how much capital will this asset need before a serious customer is willing to hire it? Here is the second surprise. You do not need to own an oil field, and you may never own a single barrel of crude. You are a drilling contractor. Energy producers hire companies such as Transocean, Valaris, Noble, and Seadrill to provide specialized offshore drilling equipment and services. The producer develops the field. You provide the rig, and the contract tells you what your time is worth. A real example shows the scale. In June 2026, Transocean announced an agreement with Equinor, covering 3 harsh environment rigs for a total of 7 rig years. The agreement represented more than $1 billion of additional contract backlog, subject to the required approvals. The base day rate was $399,000, with adjustments expected to push the effective rate above $400,000. When the work begins, think about what the customer actually purchased, not the rigs, not Transocean. Years of future access to those rigs. 7 rig years became a $1 billion commercial agreement. That is the business. You own specialized industrial capacity. The customer buys pieces of its future availability. This is why offshore drilling companies obsess over backlog. Backlog represents future contract revenue associated with committed work. As of early August 2026, Transocean reported approximately $6.7 billion of backlog. Another roughly $1 billion connected with the Equinor agreement had not yet been included because the required approvals were still pending. $6.7 billion sounds like a giant pile of future money, but the more useful interpretation is simpler. A large part of the fleet's future calendar already has buyers. That is what gives the owner visibility. In February 2026, Transocean reported that 36% of its ultra-deepwater fleet days for that year were uncommitted at that point. Those are the days that matter most. The physical rig already exists. The expensive systems are already installed. The question is whether the calendar around that asset is filling with contracts fast enough. 2 similar drill ships can therefore produce very different economics, simply because one has years of work attached to it, and the other is approaching the end of its current contract. From the outside, they look like similar machines. To the owner, one has future revenue visibility, and the other has a sales problem. Now, we reach the number that gets everybody excited. $455,500 per operating day. At 365 days, that is more than $166 million. But you do not own 365 operating days. You own 365 calendar days. That distinction is worth millions. Transocean's ultra-deepwater utilization in the second quarter of 2026 was 72.6%. If, purely as an illustration, that utilization persisted for an entire year in the same average daily revenue applied, the equivalent would be around 265 operating days. That produces roughly $121 million instead of more than $166 million, a difference of about $45 million. Nothing happened to the headline day rate. The calendar changed the economics, and even contracted time does not always earn the full theoretical rate. Transocean's own disclosures explain that contractual rates differ during certain repair periods, standby periods, weather delays, and other operating conditions. Under some contracts, extended repair periods reduce the applicable day rate to zero. So whenever you hear, this rig earns almost $500,000 a day, the number is incomplete. The next question is, how many of those days actually qualify? The contract is running, the rig is earning money. Now, look at what it takes to keep that machine producing those paid days. A modern offshore rig needs a large, highly trained workforce. It needs maintenance, inspections, equipment, logistics, onshore support, contract preparation, regulatory compliance, and periodically, expensive shipyard work, rather than build the story around isolated estimates. For one helicopter or one engineer, look at the reported company-level economics. In the second quarter of 2026, Transocean generated approximately $966 million of contract drilling revenue. Its operating and maintenance expense was approximately $608 million. That is roughly 63 cents of operating and maintenance expense for every dollar of contract drilling revenue at the company level during that quarter. That is not a final profit margin. There are other financial items below that line, but it shows the scale of the operating machine required to produce the revenue. Transocean also tells investors that many operating and maintenance costs are fixed or semi-variable and do not decline proportionally with revenue. This matters enormously. When utilization falls, revenue responds quickly. A large part of the cost structure responds much more slowly. That is where the economics become uncomfortable. Remember the used rig strategy? Here is what happens when the market decides an asset no longer deserves more capital. In August 2025, Transocean announced plans to dispose of 5 rigs through sale for recycling or alternative use. The decision was expected to create an impairment charge of approximately $1.9 billion. $1.9 billion. The machines had not physically disappeared. Their economics had deteriorated. And taking a rig out of service is not as simple as parking a truck. Transocean explains that when stacking begins, operating costs remain at or near normal levels for roughly 30 days before falling as the process continues. If the owner later decides to reactivate the rig, spending returns, shipyard work, repairs, maintenance, commercial, upgrades, equipment, materials, recruiting and training crews. The company also states that some stacked rigs never return to drilling service. So imagine buying one of those assets because the purchase price looks irresistible. The seller may be desperate, but there is another possibility. The seller has already calculated what it will cost to make that machine commercially relevant again. A cheap acquisition price does not rescue bad future economics. Suppose the phone finally rings. You have another contract. There is one complication. The rig is in the wrong region. A drilling rig can move to the customer. Moving it requires mobilization, preparation, inspections, transit, and sometimes contract-specific upgrades. That takes capital. It also takes time. In Transocean's 2026 Equinor agreement, Transocean Endurance was expected to complete its existing program and later mobilize from Australia back to Norway before beginning the new work. The next contract is already visible. The route to that contract still has to be paid for and executed. This creates an unusual economic problem. A completely functional rig with a future customer still has a gap between today's revenue and tomorrow's revenue. That gap has a location, a schedule, and a cost. This is another reason the headline day rate tells you so little by itself. The owner needs to know where the asset is now, where it needs to be next, and how much calendar disappears between those 2 points. Now add debt. A billion-dollar industrial asset makes borrowing look logical when years of contracted work sit behind it. But offshore drilling remains cyclical. Contracts expire. Energy companies change capital budgets. Projects get delayed. Rig supply changes. Demand changes. Day rates move. Utilization moves. The debt schedule keeps its own timetable. Seadrill is one of the clearest warnings. The company went through a major restructuring following the offshore downturn and later entered Chapter 11. Again in February 2021, its 2021 reorganization ultimately reduced liabilities by approximately $4.9 billion. This was not an inexperienced operator. It was a major offshore drilling company with real assets, experienced management, and real customers. None of that eliminated the cycle. That is what leverage changes. A rig can remain technically excellent, while the equity attached to it becomes financially fragile. You do not need the machine to become worthless. You need revenue to fall at the wrong time, while fixed obligations keep arriving. Now let us calculate our imaginary rig. We will not invent an exact operating cost for a specific drillship. Instead, we will use reported revenue data to isolate the variable that matters. Most paid operating days. Assume our rig earns $455,500 per paid operating day. Good year. You sell 330 days. Gross operating day revenue is roughly $150 million. Now change only the calendar. The following year, you sell 200 days. Revenue falls to roughly $91 million. The difference is around $59 million. The rig did not explode. The day rate did not collapse. The machine did not become obsolete overnight. You simply sold 130 fewer days. And now remember the company's own warning. Operating and maintenance costs do not decline proportionally with revenue. That is what turns a utilization problem into a profit problem. A strong year rewards every extra day you sell. A weak year punishes every expensive day you cannot. There is one risk our normal spreadsheet does not capture well. Deepwater Horizon. On April 20th, 2010, the rig suffered a loss of well control followed by explosions and fire. 11 people died. The rig later sank. Over the following 87 days, almost 5 million barrels of oil were discharged from the Macondo well into the Gulf of Mexico. The disaster triggered investigations and major changes in offshore well control and safety regulation. The lesson for an owner is not that catastrophe is normal. It is that safety belongs inside the economics of the business. Maintenance is part of the cost structure. Training is part of the cost structure. Well control equipment is part of the cost structure. Redundancy is part of the cost structure. At the extreme, operational failure costs lives, destroys assets, halts operations, and creates legal and environmental consequences far beyond the original contract. The customer therefore hires more than drilling capacity. It hires an organization that has to operate that capacity reliably and safely. By now, the purchase price is no longer enough to tell us whether a rig is attractive. A brand new drill ship with no customer can be economically weaker than an older rig with years of contracted work. A cheap distressed rig can require so much reactivation capital that the discount disappears. Technically strong rig in the wrong region loses valuable time reaching its next job. So before buying, the owner needs a very different checklist. What work can this rig perform? How much of its future calendar is already sold? When does the current contract end? What does reactivation require? Where is the next customer? What debt sits behind the asset? What happens if demand weakens before the next contract begins? That is why offshore drillers make decisions that sometimes look irrational from outside the industry. They scrap assets that once cost enormous amounts of money. They spend heavily on another rig sitting in the same fleet. They move equipment across oceans. They accept long contracts for visibility. They keep other rigs available because they expect stronger pricing later. The asset is physical. The investment thesis is mostly about the future. 13. Now return to the beginning. You wanted the machine that could earn almost $500,000 every day. We bought it, and almost immediately, the simple story disappeared. $1 billion construction cost did not guarantee a $1 billion asset. A cheap acquisition did not guarantee a bargain. A $455,000 operating day did not give us 365 operating days. An idle rig did not become cheap simply because revenue stopped, and a signed contract mattered only because it transformed part of the future. Calendar into something economically visible. That is what you actually bought. A finite inventory of days. The rig determines which jobs you can perform. The contract determines which days become revenue. Reliability determines how much of that contracted economics you capture. Costs determine what remains. Debt determines how much pressure you face while waiting. And the market determines whether somebody needs the asset next year. That is why Transocean's roughly $6.7 billion of backlog matters. It is not simply a large financial number. It represents future time that already has customers. Customers see an offshore drilling rig. Investors see backlog. Owners see every blank space between today's contract and the next one. Because the seductive question is, how much can this rig earn in one day? The question that determines whether the investment survives is, how many days can you afford not to sell? If you want more breakdowns of the hidden economics behind businesses everyone thinks they understand, subscribe.